Hello guys, welcome back to video number 9 in the series for this full course in institutional trading for demand and supply. Okay, so far we come a long way, and on the last two videos we've been talking about structure. Okay, and the first video we talk about the basics of structure, and we said any market is going to be delivered in three directions, right? It's going to move in three directions. It can either go up, it can go down, or it can go sideways. And market structure is just the way that in which the market's being delivered to us, in the way in which price is being delivered to us. So in an uptrend, it's going to be a series of higher highs and higher lows. On the downtrend, it's going to be a series of lower highs and lower lows. And when a market is in consolidation, it's going to be, it's just going to be on a range. So far we said we had, for example, an uptrend is going to be, there's going to be a run. There's going to be a higher low, a higher high, higher low, higher high, higher low, higher high, higher low, higher high. Okay, this is the idea that we have so far. What a high, what an uptrend is. Okay, and this is how structure is going to be delivered in the market in an uptrend. On the other video, the last video, we talk about the idea of fractality, how the market is fractal, and how you can be trading in different time frames, and you just have to learn to navigate the time frames so you can read the order flow that institutions are putting into the market, right? So we understand that if an institution got in at the bottom, let me close this. If an institution got in at the bottom, let's say right here, right? We know that now this will become a protected low, because those institutions are going to be protecting this low, so that way price doesn't come below this low and they start going negative in their orders. So last time we also learned about the idea of fractality, which just because we have this structure on the higher time frame, and the lower time frames we're gonna have other structure being put in, right? That is gonna be bullish, which then is gonna break structure and turn bearish, and then that's gonna break structure, is gonna turn bullish, right? Which then will turn bearish, and so on, right? And then break a structure to the upside again, right? So that idea, and we're gonna make this yellow, okay? So this is the idea of fractality. So we said that what we do in the idea of supply and demand is that we follow the direction of one trend. Okay, so first of all, you need to go into a pair, and you need to choose and just study the pair. Look at a different, start from weekly or monthly, daily, and then 4 hours, 1 hour, and 15 minutes, 5 minutes, and understand how the market moves. Okay, because we use time frames to see where the orders are in the markets. We don't use time frames to trade. So it depends on how liquid a certain market is. The time frames in which you will have to trade the market are going to be different. And what do I mean by that? If we go down here, right, and we look at this market right here, okay, and we look, it's a bearish market. Now we're looking at the 1 hour right now, and we can kind of see a lot, but we can't really go in deep, right? So if we start from a daily, we can kind of see on the daily run, right, what it's going on with this market. And what we're gonna see, it's this breaker structure. Now we have this, we have this, we have this, and maybe this was just a pause, and on the daily we have this, right? And maybe right now it's coming back to continue lower, right? Now inside this, as we can see, is we see the daily, but for example, if we see this run over here, it's really hard on the daily to make up the structure that is going on inside this run, right? So if we go to the 4 hours, right, on this run, now we can start to see this structure a lot better, right? And now we can start to see that we had basically this big run up, we have this hiccup, another higher high, higher low, higher high, higher low, fail to go higher, and then the breaker structure. And then from here, now we can start looking for a structure for those breaker structures to the downside, right? And but even within that structure, on the 4 hour, it's really hard to see the inner structure, right? We can kind of see that there is an inner structure inside, but it's kind of hard to see it. So if we go to, for example, the 2 hour and go back up here, now as we go down to the 2 hour, we can start to kind of see that inner structure a lot better, right? It looks a lot cleaner. We can actually make up the inner structure a little bit better, right? But then even if we go to the 1 hour, and we go back to the same last run, which was this one. Now on the 1 hour, I think we can kind of see it even more clear, the inner structure, right? And now this inner structure, we can really see this first run up, right? Then we have a higher low, higher high, higher low, higher high, higher low, higher high, higher low, right? Higher high. Then all this inside is basically it's part of this range. It's part of this run up. It never came back down, and it hasn't broken structure to the upside. Then this is the higher high, and then higher low and higher high, right? And then from there we will have basically, if we continue, a higher high, higher low, higher high, higher low, higher high, higher high up here, higher low, and finally the last high. And then as we broke structure over here, right, now we can start looking. We know that now the 1 hour has turned bearish for a little bit. A lower high, a lower low, lower high, lower low, lower high, lower low, lower high, and then it fell to create another lower low, and it broke structure to the upside, right? And then continue with the 4 hour higher structure, trend, right? Putting in that higher 4 hour structure, because this yellow was the daily, and within that daily we have, let's say this blue was the 4 hour structure, and within the 4 hour structure we have this other, let's say red 1 hour. We have another red 1 hour structure, and we can easily see that 1 hour structure being delivered perfectly. Okay, now to go back into our drawing, let's go back to daily so we can actually see our drawings right here. So now the idea, the way we trade, is we use higher time frames, right? We know that higher time frames, in this case, this purple, let's say is the daily. And then we have, let's delete this because it got ugly. So the idea of demand blocks and supply blocks is to not use just a candle, is to use the whole swings. What do I mean? The whole, instead of, we said that a supply, a demand block is the last candle before I move up, right? So if we go to price, basically a supply, a demand, it will be the last candle down. For example, this one, this red candle, the last candle down before the move up, before the break of structure, right? In this case, it broke structure higher, and this became the last candle, last down. So now we wait for the mitigation of the open to continue higher, right? Or the 50% or the full mitigation to continue higher. This candle came back to mitigate this last candle, and now this became, even though this candle is green, these wicks can also be the demand blocks, right? Because we know that at some point price came down here before moving up and closing up here. So now this wick also becomes a demand block, right? And price came back to mitigate even more. And then by this time, this started to become a accumulation, right? Or reaccumulation or redistribution, but that will depend on where our higher time frame bias, it's going. So then at this point, all this inner structure on the lower time frame is going to be in a structure, but on this time frame, on the daily, as we're doing this was just one big swing, right? And then price came all the way down. All this is still inside the range, and this was the first break of structure, and then it broke structure to the downside, came back to mitigate the heights, and then continue lower, right? That is how the structure. And the thing is, we don't know this until we don't know this is gonna happen until it happened, until after, right? Now, we can come back to the past. It's really easy to market, but when price was here, we really didn't know what was going on. And that's why we choose our time frames. We have to see each market and see and learn the market. What is the time frames that you can actually see the structure better? For example, in this case, if we start from a daily, we can see the structure on a daily. Now, how can we actually trade these daily swings? Because the thing is, you can trade this, but you will have to be a swing trader, because for just one leg to form, it takes about 77 days for this leg to form, right? And now this other leg from here to here, it took another 76 days, right? This leg from here to here took 84 days. Now, are you gonna hold your trades for 84 days? I don't think so. And that's why you have to learn about time frames. You have to learn that the time frames are not there to trade the time frames, but to show you what the order flow in the market is. In this case, we know that the order flow is bearish because on the daily, the bearish order flow, is holding. This swing, this protected, swing is holding. This lower high is holding. This lower high is holding. Lower high is holding. And right now, from this daily, what I see is this is my protected swing. And I will be on the daily, I will be bearish until a candle closes above this. If I'm trading, daily, and I want to be an intraday trader, and I want to be, or maybe a like a short-term swing trader, right? And I just want to hold my trades basically 3 days or a week, right? I'm not gonna wait for price to come all the way up here. It might take, I don't know, look, just from here to here, this took 23 days, right? Now from here to here, this leg, the last leg to form, it took 48 days, about 48 days, right? So am I gonna be waiting 48 days? No, right? What I'll do is, now I know that this was the last point break of structure that we had on the daily, and right now we're starting to put up a bullish structure, right? I can see it right here. So I need to figure it out which structure makes the daily. Now most of the times it's gonna be the 4-hour structure that makes the daily structure. And then on the 4-hour, if we go down, we are going to start seeing that from here we had this run, right? And then we broke structure here, and I will take this whole swing as one, and then this one, and then this one, and then this one, and then this one, and now we just broke a structure to the upside. So what is this telling me right now? It's telling me that we just broke structure on the 4-hour time frame, right? And the 4-hour time frame is just now, it just turned bullish, but the daily structure is still bearish until a daily candle closes above this line over here. My higher time frame is still bearish. I'll still be looking for long-term bearish trades, but within that, there's nothing stopping me right now, because inside this breaker structure, what do you see happening? We have the 1-hour. We have the 1-hour inner structure also playing out, right? We had this swing, last swing low, right? Came back up, came down. This was still part of the range, broke structure to the upside, and now leaving behind the last swing, and then moving up, moving down, moving up, moving down, and now what do you see, right? We have this last swing up, right? And then we have this swing right now. There's higher low, and right now we're still in the bullish. So there's no point, if I want to be trading the 4-hour, there's no point of me trying to catch the top until this 1-hour structure actually breaks structure. At that point, I know that we're starting to put a 4-hour bearish leg. Okay, at this point where we broke structure to the upside, I knew we were starting to put a 4-hour bullish leg, right? And this 4-hour bullish leg, once this 4-hour bullish leg, the inner structure of the 4-hour bullish leg, which is made of 1-hour bullish structure, right? Once the 1-hour breaks a structure, now I know that there is a daily bearish bias, there is a 4-hour bearish bias now, and there's a 1-hour bearish bias. So at that point, once this breaker structure happens over here, right? Let's say price comes up here and then it comes down and breaks structure to the downside, right? Now my goal will be to have the last move up before the move down, and I'll wait for price to come back, and this is where we're going to start making rules for our trade, right? For our trading strategy. we're going to start creating our trading strategy. We're going to wait for price to either come to the open, right, to the bottom, to the open of this supply block, or we can have a rule to enter at the 50%, or we can have a rule to go down into maybe the 5-minute structure, the inner 5-minute structure of this move up. And once that 5-minute structure breaks, it's going to be bullish, right, as it's coming up. And once that 5-minute structure breaks down, then we can enter on the lower time frame in the 5 minutes, right? But let's say we have a rule that because we already broke a structure on the down on the 1 hour, that was our confirmation, and now we just put a limit order because our rule is that we always take the 50% of the supply block. So in this case, basically price will come down there and now start printing lower structure, right? Now trading, it's technical analysis, it's only like 30% of trading, okay? About, I'll say another probably 35% is going to be, or more probably, is going to be managing, money management, okay? Money management and trade management. That is going to make it profitable, okay? And the other 35% is going to be psychology, for you to be able to execute the trades flawlessly over and over and over again, even if you're going into a drawdown or if you're into a big losing streak, okay? Because over the long run, if you test your strategy, you know that you have an edge, and your edge is not gonna play over 5 trades, over 10 trades. You need to at least have a sample size of, the minimum should be 100 trades. So to continue, as this breaker structure happens to the downside, now we know that when this breaker structure happened over here, we would have been waiting for a short position at the 50% of this block with the stop loss above the high, right? And then where we're targeting, first we should be targeting the last 1 hour right here, the last 1 hour low. Why? Because what's happening here is price can easily come to somewhere deeper over here, right? Price can come deeper over here and then break a structure to the upside and continue higher to then break a structure and continue lower, right? And this will still should be fine with us, because if we go to the higher time frames, the daily will still read, it never broke structure, and the 4 hour, it was just a little pullback on the 4 hour, right, to create the pullback on the 1 hour, on the daily, to continue the bearish daily push, because the higher time frame is always going to be the one that matters, and then the inner time frame are going to be changing all the time. And that's why trade management, it's so important. We can't just take this trade and expect that just because we broke a structure on this 1 hour, right, and now it's lining up with the 4 hour and it's lining up with the daily, just because this breaker structure happened, it doesn't matter. We should be trading all the way down here, right? Or all the way down here, whatever. If we look at the left side over here, whatever structure we find over there, it doesn't mean that way. What we do is we should be trend followers, and we follow the trend until the trend doesn't want to give us anything anymore. Okay, so until we find breaks of structure, we're gonna stay in the trend, right? So how do we trade this? Is the once we find this breaker structure, Now we know we're bearish, right? And as we're bearish and we break this, let's put our thing over here again. So the way we manage this trade will be that we know our take profit, our first take profit should be here, right? Because this is the 1 hour low. So, but first, as price is coming down here, right, and it created this low, and it broke this first low over here, right? The moment that it breaks this low over here, we should be at break even. The moment that this happens over here, right? Because it broke this structure, came back down, went up, right? It put us into the market, and our first step should be to wait for this low, because if this trend is going to continue, it's going to continue that market structure delivery in the bearish manner of 1 hour structure, 1 hour lower lows and lower highs. So it just created a lower low, right? That gave us the heads up that is telling you market might be going bearish. We placed our order here, right? And then it put us into the market, never stopped us out, and then we're expecting for this low to break if it's a really breakout structure. And let's say it does. The moment that it trades below this, what do? We move our stop loss to break even. We're not moving our stop loss to break even just because we want to. No, it's because we are continuing that break. We know that now we broke a structure, and now this should be our protected low. And if the market wants to continue that bearish push, it should not come back all the way up here. It might come here, or this push might be, might come all the way here, right? Or this push might come all the way here, but it should never go above this high, right? So price can come even over here to mitigate the 50% of this trade. And this is where we start building into positions, because this is the same at this trade before. So if we already are into a position here that broke structure to the downside, this trade is already a break even, so we're not risking any money on this trade anymore. But look, at the moment that we were down here, how does this look? This looks like the same setup that we took over here. So what can we do, right? We can expect maybe price to come back to the 50% of this one, because now our block is no longer this one. Our supply block is this one, right? And this is the same setup, 50% of that. If price comes to the 50%, we will put another trade that is going to be, the stop loss is going to be up here, right? Why? Because if we continue going higher, this gets invalid and there was no trade. But if it keeps going lower and it breaks this structure, now guess what? We can already manage the first position that it was basically 1, 2, 3 when we took it, and we could take half of this position out and then move this to now break even. So now we already made half, let's say 1.5 RR on the first trade, and on the second trade, which is this one, we should be already sitting at basically 2.5, but now we can have this one, move our stop above the high, right? And now probably we cut our risk, by 50%, or maybe we can even move it to break even already. And now we have basically 1.5 position because we had two positions already, but on this one we took half the position, and on this one we already took basically one. We just move it to break even, so the full position is still running. So 1.5 position, still running. But since this already broke structure to the downside, what do we see here? Look, it's the same setup as before. The last move up before the move down. And if our rule is, guess what? It's 50%. We will be waiting for another 50% entry on this move. Now, let's say in this case, price didn't go all the way up, right? Price didn't go all the way up. And what happened was it put, another lower low. Now, the moment that this trades, below here, what do you think is going to happen? We can take another, we can move this one to already. Now we can take half of this position, right? Because we had already at this low, we broke it even, and then it started to go up, and then it broke structure. So the moment that broke structure down here, we can take half of this position too, which in this case will be like another, like almost 1 hour, right? And we had this other position also running all the way to here, right? And at this point, you can take probably another, 25%. You already closed 50%. You can have another 25% on this, on the first trade. And now you have basically two positions still running. And this one, we never got the entry because it didn't come up here to tap you in. So this is the one that we're using, right? And then now on this one, the moment that it broke structure, now what do we have? We have that this is the last move up before the move down, right? And now we're waiting for the 50% entry over here. Okay, we're waiting for the 50% entry over here, right? And on this one, what do you see happening? It came all the way here, and now our stop loss, don't have to be here, right? Our stop losses can actually be somewhere here, right? Above this high if we wanted to. Like, you can experiment. There are many ways to manage your trades, okay? So that's why it takes a long time to become fully profitable, because you can find good trades all the time. The problem is that you're going to find a lot of bad trades all the time too. And if you're not consistent, if you don't have a good management strategy, you're going to make money, but you eventually going to give it all back. Okay, so the moment, for me in this case, the moment that this broke structure to the upside, I close all my positions, all my trades. Or usually what I do, because everything is lining up, basically I will close 80% of all the positions that I have close, and I just leave 20%. Why do I leave the 20%? Because sometimes, and it has happened, doesn't happen all the time, but sometimes this can easily be just come up here to mitigate more of these zones up here, and then continue the bearish move, right? And sometimes as it comes back down here, sometimes it never comes back to give me an entry, and it just falls off. So if it falls off, I still have 20% on this position, 20% on this position. So that's 40% of a full position that's still making me money on the way down, instead of just closing everything, right? But let's say this didn't happen. I have 20% of these two positions still running. But now, because this broke structure, what do you think is going to happen? Now I'm no longer looking at bearish moves because I'm following the 1 hour structure. And the 1 hour structure just told me that it went bullish. So now this is my move, and I'm waiting for price to come back down to the 50% if that's my rule, right? And in this case here, it never gave me an entry. So this move up, I would not catch it, right? And then the moment that it broke structure to the upside, now this became the last move down, right? This became the last move down. And if my rule is the 50%, price never came back down to the 50%. So I didn't get an entry on this one. And then the moment that it broke structure to the upside, right? This became the last move down. Now I'm waiting for an entry at the 50% of this. And it came back down, right? It moved up. So at this point, it's not a breaker structure to the downside. It's not a breaker structure to the upside. Why? Because this one hasn't broken structure yet. Okay? So at this moment, this is just one big run. So I'm waiting for price to come to the 50%. And then over here, as it comes to the 50%, I would enter, but then it fell. The moment that it fell, now I know that we're going to the downside, right? Now we're going bearish again. So now the last move down, the last move up will be this one. The last move up will be this one. The last move up will be this one. Now, the way I just drew it, it's, we didn't get an entry on all this. We got plenty of entries over here, but we didn't get entries over here. And that's what I want you to understand, that the market actually moves in this manner too. You are going to create rules for your trading strategy, and sometimes those rules are going to meet, and you're going to have perfect entries that are going to run, and sometimes your bias is going to be correct, your analysis is going to be correct, but your rules didn't meet all your criteria, and you shouldn't take those trades, and the market is going to run without you. And that is okay, because the market is not going anywhere. Just because you didn't get an entry over here doesn't mean that later price is not going to come back somewhere here, and then break a structure to the downside, give you a perfect entry over here, and then fall off the earth. And give you a huge trade over here, right? You just have to practice. And this is what I was telling you. Practice makes you better. It doesn't make you perfect, but it makes you better. Because practice and the analysis of your trades, you have to study the trades that you take and the recording of your trades and going back through the data. That's what's going to make you a good trader. Data is freaking key in this market. This market, it's a numbers market. And if you don't have data saved to go back and analyze, then you're never gonna become better. Why do you think we have all this social media and apps and this a bunch of apps on your phone that tracks data of all the things that you do, all the things that you watch, how long you watch them, what are the topics that you watch, like where you going every day, what are the shops that you visit? Why do they save all the data, and why do they sell that data for so much money? Because data is valuable. Because if you have data, you can make good decisions, right? And I'm not gonna tell you how to manage your trades, because it will depend in the type of trader that you are. I can tell you, move your stop loss after 20 pips, because what if some news happen and that candle, it was just one candle that moved, out of your entry, and it hasn't created any structure yet, and it might come down to to the last move up, the last candle up, to mitigate and then continue in the direction that you had predicted. But because you move it to break even, now you get taken out. So you have to take the journey, and that's why trading, you have to enjoy trading, because there is so much behind the scenes that a lot of people don't teach you, on all those courses that they're trying to make you rich in 3 weeks or 4 weeks. Trading is hard. It's not easy, and it's a lot of it is mental, and a lot of it is trade management and position sizing. Okay, so I think we're gonna stop right here with this video. I hope you kind of understood a little bit of how you should be looking at time frames instead of just jumping into a market just because you want to be a 4-hour trader. No, it has to depend in the time. Because, for example, you can be a 4-hour trader, right? And right now it just broke structure to the upside, right? So if you're a 4-hour trader, that means all this time that this market has been bullish, you were just sitting down here, maybe waiting for this zone over here, right? So you can take it to the downside, and then it broke structure, right? And now maybe you're looking at another zone over here, and it broke structure. So by the time that this broke structure, now this is your last move down before the move up, right? And now you are going to be, let me actually, yeah, let's delete everything. So it says here, right? So right now, this was the last swing of the 4-hour, and we just had candle close, because this is the 4-hour structure. We need a 4-hour candle to close above this for it to be valid, okay? For it to be a valid breaker structure. So we just had a 4-hour candle close above this 4-hour high, right? So that tells us that the 4-hour has turned bullish. And now, if you're trading the 4-hour, you should be waiting. This is your last move down, okay? And if this is what you're trading, and let's say you have the rule of 50%, you should be waiting for an entry like this, and maybe take it, to up here, right? Because the last daily point, because on the daily, the last move daily was this one, and this is the daily that we are really that we really care. So this 4-hour structure can easily just do this, right? It just broke structure, come a little bit higher, come back here, higher, mitigate the 50% of this, start breaking structure lower, and continue lower, right? The market can easily do this. So what you're doing is you're going to be in this trade, riding this 4-hour short-term bullish structure to come and mitigate the 50% of the last daily, because this was the last daily block. It wasn't this one, right? This was the inner 4-hour right here. This was the 4-hour, right? Here and here, and we just broke structure on the 4-hour, and this might be happening in the 4-hour to come back into this block, maybe mitigate the open, maybe mitigate the 50%, maybe mitigate 100% before falling. We don't know. We're just going to stay in this trade, right, until it no longer wants to follow the higher and higher lows, and it breaks structures, and then now we're gonna be bearish, right? We're just gonna follow the trend. We'd rather be wrong one time over here than the market coming over here and enter over here and then it fails. Oh no, now it has to be this zone right here, and it's gonna come here and then it fails. Oh, we're gonna enter over here, it's gonna come here and it fails, right? We'd rather follow this structure until it no longer wants to continue. Okay, so just a little recap, and with the with the drawings, we say that our supply block is the complete last move down. I mean, the demand block is the last move down before the move up. And it only becomes available to trade after it breaks above the high. So for example, as this structure was put in, right, it started to break down, right? And we're looking for bullish pushes now. So the moment that we break this high, it's telling us the market is bullish. So now our block is going to be this last move down, and we're going to make this maybe yellow, and we're gonna make it a little bit thicker. Okay, this became our last move down. And now here's where we have the options to add to our rules, right? Do we want to enter at the open? Do we want to enter at the 50%? And just place an order and just trade it as it is? Or do we have a rule where, we go to the lower time frame that makes this higher time frames? So if this is a 4-hour structure, we'll go to the 1 hour and wait for the confirmation on the 1 hour breaker structure bullish, and that will confirm that the higher time frame and the lower time frames now are bullish. So we can take an entry on the lower time frame, and instead of having a huge stop loss from here to here, or from here to here, we can have a smaller time frame in an inner structure, right? And manage our trade on the lower time frame structure, right? So, but for now, let's say our strategy is that we are going to take our trade once it comes back and mitigates the open. So we'll be waiting for an entry right here with the stop loss just a little below, right? And that will be our first trade. And guess what? Once it breaks above this high, it's telling us that the trend wants to continue. So what can we do? Now we know this, it's no longer valid because we're already printing a higher low. So now our block, our demand block is this one. And if we keep making the same rule, what should we do here? We should apply the same rule, because this breaker structure is telling us that the market wants to continue bullish. So as it comes back to mitigate the open, we'll place another trade here, expecting to continue bullish. And our stop loss should be here, right? And this stop loss, now we should move it up here as well. So that way we don't have the full risk on this position, because we don't need to have it over here, because we're already saying that we had this breaker structure and price shouldn't go lower than this low, right? Because it's already broke structure up here. And as it comes down and break structure higher, this will get moved to break even, and this trade will get moved just below that low. Because guess what? Now, since it broke above this high, right? Now our supply block became this one over here, right? So there's no need to have this stop loss all the way down here, because we already broke structure up here. It validated this block, and now we can have a stop loss over here, and this trade is already a break even. And now, we can have targets to where we want to take maybe 5%, half of our positions, right, already at certain determinator RR. Let's say you want to take half of the position always at 1 to 3, right? And then you will take half of that position, and now it will be basically half of that position still running, but a risk free. You're no longer risking anything on that trade. That trade is already positive because you already took 1.5 or R. And then this trade from, before it was from here to here. So now you have basically 1/3 of the position only running, right? But look how we are moving our trade, right? How are we managing our trade? I'm not moving it to break even. I'm moving it to the last structural point. Why? Because price from here can do anything it wants. Like, it doesn't have to do what we want it to do, right? It can easily come to the open and continue. It can come to the 50% and continue. It can come to mitigate almost 100% and continue, right? Or it can either from here come a little bit lower to take the stops over here, like a stop hunt, right? Over here to continue, right? That's why we have to protect ourselves at the structural points. But the idea of a supply and demand block is that we don't use one candle. We use the full opposite move that created the breaker structure. For example, in this case, the last move down before the break structure to the upside. In this case over here, the last move down before the breaker structure to the upside. And on the bearish market will be basically the same thing, right? Breaker structure, breaker structure, breaker structure, breaker structure. And then over here will be the last move up before the breaker structure to the downside. Then the last move up before the breaker structure to the downside. The last move up before the breaker structure of the downside. And then the last move up before the breaker structure to the downside until it no longer wants to continue bearish. And now we will, what was the move that broke structure? To the upside. So now the last move down that created the broker structure to the upside, the last move down that created the breaker structure to the downside, and so on and so on. And we just follow the trend until no longer wants to continue. All right. So on the next video, we are going to take a look at more examples on live data, the live market. But we're going to stop this video right here because it's been pretty long already. But I hope you guys got something from this video. And if you did, please leave a like and subscribe, because there's going to be a lot more videos where we're going to go in depth. And if you have questions and you want me to make a specific video of something that you didn't understand, please leave your questions in the comment, and I will definitely make a video explaining that topic and in more in depth. Okay. Thank you guys. As always, Jay, and it's a pleasure for me making these videos, and I'll see you guys in the next one. Peace.